What's up everyone, it's Scotty with MoneyVest. So in today's video, we are going to be talking about one stock that is now setting up for a nice potential opportunity here after gapping down quite significantly after providing some weak guidance for 2024. This is a very high quality business, one of the strongest brands in the US, and it is down a little bit over 20% from its all-time highs, 25% to be precise, and indeed one of the worst performing stocks in the S&P 500. So this right here is a list of all S&P 500 stocks that are down by more than 20% on a year-to-date basis. So of course, as you'll notice that we have Tesla on the list leading the way. At least Tesla is leading the way in something, down over 29, almost 30%. Boeing is down over 26%. We got Charter Communications down 25%. We got Market Access down 25%. And we got Warner Brothers Discovery, we got Walgreens, Boots, of course, we got Paramount Global. The company that I'm talking about today is going to be none other than Lululemon. Lululemon Athletica down a little bit over 23% on a year-to-date basis, and perhaps the only stock that is still up on a 1-year and a 3-year basis in the S&P 500 of the companies that are down over 20%, and it's actually been one of the worst performing stocks in the last 1 month as well. As you'll notice, it's down almost 16% in the last 1 week, down almost 18% as well. So we're going to discuss everything about Lululemon and whether this pullback, this sell-off is an opportunity for this stock or not. As you'll notice that revenue-wise, we're looking at Lululemon at just over $9.6 billion in revenue with a P ratio of about 31 and a beta of 1.33. It's actually one of the lesser volatile stocks. Beta is essentially a measure of volatility, and 1 is the market. That's the standard. Anything that's over 1 tends to be a little bit more volatile than the market. Anything that's under 1 is less volatile than the market. You'll notice Tesla's at 2.43, meaning that it's incredibly more volatile than the S&P 500. And Walgreens is 0.73, meaning that it's significantly less volatile than the S&P 500. Lululemon being 1.3. means that it's 33% more volatile than the S&P 500. And this right here is the entire sell-off that I'm referring to. So it's down a little bit over 24.5%, trading now just over $394 per share at the moment. So let's discuss whether this company, whether the stock is a buying opportunity or not. Now, this company did actually beat earnings expectations by about 5.5%. So they reported revenues of just over $3.2 billion. So this right here was both a revenue beat and an EPS beat. So $3.2 billion in revenue and earnings per share coming in at $5.28. They reported on March 21st. So just last week they reported, and the stock obviously took a dive because of weak guidance. So shares plunged 16% on weak guidance, slowing in North America. So what I just mentioned here, again, earnings per share and revenue coming in very nicely with a strong beat. But the company, of course, did report some weaker than expected numbers, as Calvin McDonald, the CEO of the company, basically mentioned, and I quote, "As you've heard from others in the industry, there has been a shift in U.S. consumer behavior as of late, and we're navigating what has been a slower start to the year in this market, and we view this as an opportunity to keep playing offense as we lean into investments that will continue our growth trajectory. Outside the US, our business remains strong." And the biggest thing was, within the US, they actually saw sales grow over 9% on a year-over-year basis compared to the 29% growth witnessed in the year-ago period. So same time last year, they actually saw a growth of 29%. And now they saw a 9%, which is, again, a slower growth rate. And as a result, the stock absolutely got sold off because they did see, again, softer growth here, softer demand. And they also did mention, let me just go back a little bit. So they added that both traffic, and again, this is where the actual pain comes in for the company. McDonald added that both traffic and conversions, right? So both traffic and conversions are down in the US. He attributed that the lack of products in sizes 0 to 4, key sizes for the US customer base, and not enough colorful items is really what resulted in the sell-off in Lululemon here in the fourth quarter 23. Meanwhile, international sales are very strong, growing at 54% on a reported basis, with sales in China growing 78% and 36% in the rest of the Lululemon's markets as well. And this right here is the entire guidance. So this is what we're looking at in terms of guidance for the current quarter, which is first quarter Q1 2024. Lululemon expects net revenues to be between 2.18 and 2.2 billion. representing about a 9 to 10% growth rate on a year-over-year basis. Analysts were expecting 2.25, so a little bit softer guidance here and expecting 12.5% growth, and earnings per share expecting 235 to 240, below the consensus of 255 from the analysts. And for the entire year 2024, they're expecting revenues between 10.7 and 10.8 billion. Again, softer guide compared to the 10.9 billion expected, and diluted earnings per share between 14 and 14.20, which was kind of in line with 14.30 estimates for the company, which is perhaps one of the biggest reasons why I'm going to put this in green, why this is a straight up overreaction, because at the end of the day, the only thing that really matters and should matter for investors, for institutions, for analysts, for everybody is the entire year's earnings per share. And the analysts were expecting 14.13, and they got somewhere between 14 and 14.20. So they were right on target with that guidance for the entire year earnings. Yes, softer guide on the revenue for this quarter. Yes, softer guide on the earnings for this quarter. Yes, softer guide for the full year revenue, but strong guide on the diluted earnings per share for the entire year. And that's, at the end of the day, that's really what matters. So if you take a look at the balance sheet here for the company, there's a few things that I want to look at is inventory buildup. Because of the softer demand, I'm really interested to learn whether there's been some type of inventory buildup for the company. And thankfully, that is not the case. If you take a look at inventories over here, I mean, we've gone from 1.4 billion to 1.3 billion. Now, this is still a pretty significant amount, because if you do the math, 1.3 billion divided by 7 billion, which is their total assets. So if you do the math here, we're looking at about 18.5%. So 18.5, close to, let's just say 20% to round things up. 1/5 of their balance sheet is in inventory. So that is, definitely a little bit of a higher inventory level. However, it was much higher back in 2023, because total assets back then were 5.6 billion versus the same amount of inventory. So 1.4 divided by 5.6, we were actually dealing with 25% of inventory levels back in 2023 versus the 18.5% inventory level in 2024. Total current assets sitting at 4 billion, which is a significant increase from 3.1, because cash and cash equivalents have gone up from 1.1 to 2.2 billion. So more than doubled the cash in the last 1 year for the company. If you come down, total assets sitting at just over 7 billion. And then if you come down, total liabilities are going to be sitting at, let's just take a quick look, deferred income tax liability, stockholders' equity is $4.23 billion. So when you do the math here, 7 minus 4.2, we're looking at a total liability of $2.8 billion, right? $2.8 billion, that's accounting for everything, right? Short-term liabilities, accounts payable, long-term debt, everything. That's $2.8 billion, which is, again, a little bit comparable to the overall cash on the balance sheet. So I would say that the company still has a pretty good balance sheet, in my opinion. And total current liabilities are going to be sitting at around 1.6 billion versus total current assets of 4 billion. So very, very strong current ratio. And even if you take inventory out of it, quick ratios is still pretty solid, because if you take inventory out of total current assets, we're sitting at roughly about 2.7 billion, and total current liabilities are 1.6. So again, more than once amount of current assets over current liabilities. So balance sheet's good. Balance sheet's always been good for Lululemon. And this right here is going to be the earnings expectations. Now, even despite the softer guidance, look at Wall Street expectations for earnings. I mean, they are expected to really grow and do well. 11%, we're looking at 12%, 12%, 20%, 19%, 18%, 15%. So these are strong growth numbers here from the company, and the earnings expectations are resulting in a lower and lower P multiple as time goes on. We're going from 27 down to about 12.5 by the year 2030. This right here is going to be the revenue expectations. So again, you'll notice that the revenue expectations are also pretty solid. Growth rates of 12.5, 10.5, 10%, 10.5, 9.5, 11.5. So again, these are pretty solid low double digits to high single digit numbers, and growing from about 10.8 to over $23 billion by 2033. So more than doubling the revenue numbers here. When it comes to margins, as we have already discussed, I mean, gross margins at 58%, free cash flow is 15.5%, net income 16%, and very, very, very strong return on capital, assets, and equity here of 28 to 21%, 42% return on equity, and profitability per employee at over $40,000. And that's gone up from $31,000, $32,000. So on a 5-year basis, on average basis, the company was generating $32,000 profit per employee, and that number has gone up to over 40,000. So that means the company is becoming more efficient over time. So that is, again, a very strong number here. And cash per share sitting at around $17, almost $18 per share, and $2.3 billion in cash from operations. So bottom line is, Lululemon is one of the strongest businesses out there with an excellent balance sheet, excellent margins. Shares outstanding has also been pretty stable. So if you come over to the actual stock here, so if you come over to this, statistics wise, you can take a look at shares outstanding being very, very stable. In fact, they've been going down from 123 million down to 121 million here for the company. And if you do some very simple math in terms of earnings for this year, we're looking at, let's say, $14.17. Let's just price in for $14.15 because the company is guided for somewhere between 14 and 14.20. So I'm going to go with the mid guidance here, multiplied by the actual number of shares outstanding at 120.89, and we're looking at a net income of just over $1.7 billion for the business, right? So if you plug in Lululemon over here, 1.7 billion, so 1.710, and we're looking at a growth rate of, let's say, 20%. Actually, 20% might be a little bit on the higher side, because if you come back here, we're looking at, somewhere between 12 and 20%. So perhaps we can go with 15%. I think might be a lot more reasonable here for the company. And then, of course, a P multiple of closer to 20, because right now, if you come over to valuations, if you go over to statistics, right now it's trading at 31 times earnings, 5 times sales, 21 times cash flow. Because if you do the math, 391 divided by 1415, so 391 divided by 1415, 27 times forward earnings multiple for the business. So if I apply, let's say, a 20 or a 22 times P multiple, 12% discount rate, 10% margin of safety, and about 0.5 share dilution, 0.5% share dilution, we're looking at a fair value of 327, which actually makes Lululemon very close to its intrinsic value of only 16% downside needed. And this stock will most likely be trading close to its intrinsic value. Now, you can go with even conservative estimates, like if you believe that, okay, you know what, Lululemon may not grow as fast as what analysts are expecting. I mean, right now you're looking at, 11.2%, 12.8, 12.7, 20%, 20%, 18%, 15%. So if you kind of average those numbers out, we're looking at 14 to 15%, which is exactly what I went with, 15%. But if you believe that, okay, you know what, let's just go a little bit more conservative here, 12% and a 20 times P multiple, now we're looking at an intrinsic value of 260, which only means that Lululemon only needs to drop by another 33%. And you know what? This is after accounting for a margin of safety of 10%. If I go with 0% here, now we're only looking for a 20 to 25% drop in order for Lululemon to be trading at its intrinsic value. So this right here is going to be that sensitivity grid, and you can take a look based on different growth rates, based on different price earnings multiple, where the actual fair value, where the actual intrinsic value will sit for this company. So let me know your thoughts down in the comment section below. And this right here is definitely a pretty significant sell-off, trading below the moving averages. This is the entire technical analysis. And as I mentioned before, that this right here, the green rectangle that you see that I've marked in one of my previous videos, would make for by far one of the best buying opportunities for Lululemon, because at these prices, let's just do 255 divided by 1450, we're looking at 17.5 times earnings multiple for the company, right? So P multiple would be 17.5 on a forward basis for a company that is going to be growing earnings by, on average, at least 14 to 16%. So not bad PEG ratio. It's going to be close to 1, a little bit higher than 1, but it's going to be close to 1 for a company that, again, has a very strong brand, excellent balance sheet, stable shares outstanding, very good management, and of course, we've got very good margins and profitability and efficiency as well. So keep a support level here. That is the first area of support. So this is the green rectangle, previous resistance acting as a support, sitting roughly at around 386, 387. In case we break down even further, which could happen, then the next level is going to be closer to here inside this green rectangle between 255 and 280s. And also keep a close eye at my fair values here, because they're most likely going to be ending up over there as well. So that could be an opportunity for us to start looking into selling some puts for this stock at those prices. But as I said, on a weekly time frame, you can see the RSI, the MACD starting to roll over a little bit. We've got that 200 SMA and of course the 100 SMA sitting roughly at 364, 360. That's going to be aligned at those two levels, to the white line and the blue line. And like I said, the ideal price point, the best price point, is going to be inside this green rectangle. I'm going to set some alerts for those prices for Lululemon. So let me know your thoughts down in the comment section below. As always, make sure that you drop a like and subscribe to the channel. It is one of the worst performers in the S&P 500, down 22% on a year-to-date basis, but I would love to know what you all think in the comment section down below. As always, if you enjoyed it, found it helpful, make sure that you drop a like and subscribe to the channel. And again, links to our Discord and Patreon is going to be down below. We'd love to have you on board. There is a 16% annual discount that's available until the end of this month with a few more spots left, and we'd love to have you on board. If you have any questions, feel free to reach out. As always, happy investing. I'll see you all in the next video.